Thanks for clicking. It's too early to be talking about cutting interest rates. This according to Bank of Canada Governor Tiff Macklem during his year-end speech.
How could you possibly know that?
Indeed, this was a divergence from what we heard from the Federal Reserve this week, which announced it planned on cutting rates 3 times in 2024, leading to what some are calling a pivot party, with the yields on U.S. and Canadian bonds plunging all week. And, at the press conference, the governor was asked about the apparent divergence between what the markets are expecting, rate cuts in April, and what the governor is saying, too early to be talking about rate cuts. And the conference comes as some of the usual suspects are saying that rate cuts next year will send house prices soaring back upwards. These suspects include Mr. Phil, young buyers should look at variable rate mortgages back in 2021, Soper, back when the money supply was doing this. Either Soper didn't know what the money supply would do to inflation, or he did know and said it anyway, either of which are fairly telling.
You're getting one way or the other.
Given that the imminent rate cuts and what they'll do to house prices is the dominant narrative currently in the media, the speech and the press conference from the governor was particularly timely. So what I want to do today is briefly go over the governor's speech and the press conference thereafter, take a look at what the governor had to say about what the markets are predicting versus what the bank is saying, and then discuss what to look for next. Speaking of next, Stats Canada is set to release Canada's CPI data for the month of November on Tuesday, and we'll obviously have an update out on that inflation data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into the governor's speech. Onto the speech. As mentioned, the governor was quick to push back against those who have been predicting that imminent rate cuts are coming down the pike.
I know it's tempting to rush ahead to that discussion, but it's still too early to consider cutting our policy rate.
And the governor noted that the bank is still concerned with inflationary pressures, including food at 5.5%, non-durable goods at 4.5%, and shelter services running at 7%.
Yeah, well, there's a way to fix that.
The governor then reiterated that the bank wouldn't even be discussing rate cuts until it saw that inflation was on a sustainable downward path, meaning more than 1 month's data.
When it's clear that inflation is on a sustained downward track, we can begin discussing lowering our policy interest rate.
And this was the message that diverged so much from the Fed, which announced that we could be seeing up to 3 rate cuts in 2024, whereas the bank currently isn't even thinking about rate cuts.
My dad's smarter than your dad.
Now, on to the press conference where the really interesting stuff happened. He looks so happy to be there, doesn't he? As a brief side note, I had made the joke a few weeks ago about the governor getting frustrated with reporters constantly asking about rate cuts, that he was going to have Senior Deputy Governor Rogers do the next one. And then, at the conference, the governor basically said as much.
Next year we will be moving to 8 press conferences, so every decision you'll get to ask me questions, along with the Senior Deputy Governor.
Oh, you.
But at this conference, I think for the first time this year, nobody asked about rate cuts. Instead, asking about the risk if the Fed moves ahead with its cuts and the Bank of Canada doesn't.
How Canada is a lot more rate sensitive than the US, and we're starting to see slower growth in the economy here. Is there a risk to delaying the consideration of rate cuts here?
And that's definitely a reasonable question. We've spoken a lot on this channel about what happens if the Bank of Canada is ahead of the Fed with rate cuts, as that would put downward pressure on our currency, leaving Canada to import inflation. Yet, now with the Federal Reserve announcing rate cuts in 2024, the worry is that we'll have the opposite problem. The value of the Canadian dollar would rise too much relative to that of the US, which would hurt our exports. And, on this worry, the governor didn't really answer the question.
There are risks on both sides. And as I said, we are in a difficult part of this monetary cycle.
The governor went on from there, noting that the bank is more concerned right now with not doing enough on inflation and remains primarily focused on getting the CPI back to 2%.
We're not taking further increases off the table. If we need to do them, we will. We haven't yet been discussing rate cuts, and I expect what we will be discussing is more, how long do we need to stay, how long do rates need to stay elevated?
And yeah, that's the bank's mandate. It's not the economy, it's not jobs, it's inflation. With that said, if the divergence between the Bank of Canada and the Fed went on for too long, if the Fed lowered its policy rate much lower than that of the Bank of Canada's, chances are that divergence would lead to a recession, like we had in the 1990s, leading to the major disinflation that we also saw in the 90s, and then the Bank of Canada could cut rates. Next, as mentioned, the governor was asked about the rate cuts being priced in by the market.
Governor, despite what you've said about it being too early to talk about interest rate cuts, markets are pricing in a 25 basis point cut as early as April. Is there something they're not understanding in your message? Is there a reason for this apparent disconnect?
But now, I'm not an expert in body language, but to me, that doesn't look like a governor that's confident that the markets have it correct. With that said, the governor noted that the market should be having a hard look at the core CPI.
Core did move down both on a year-over-year and importantly on a 3-month basis. That's a good sign, but one month is not a trend. We need to see further and sustained downward momentum.
Macklem then went on to note that the bank is looking for moderation in wage growth, currently running over 4%, lower corporate pricing behavior, which at the last survey showed that firms still plan on raising prices more than normal next year, and inflation expectations, which have been getting better, though not as fast as the bank would like.
And they're coming down, but they're not coming down as fast as inflation or even as fast as our own forecasts.
The governor then summarized that the bank is looking at all of these indicators, and we're just not there yet.
Watching those closely to be assured that we're clearly on a path back to 2% inflation. We're not there yet.
And I think that makes sense. The only time over the past 20 years that food inflation has been at this level, and we also received rate cuts, was in the aftermath of the 2008 financial crisis. Over the past 15 years, we've never seen rate cuts when core CPI was this high, as, despite being on a downward trajectory, core CPI has never been this high. So, what the governor is saying is that despite the pivot party, despite the apparent cuts being planned by the Federal Reserve, the reasons for which are a whole different topic, which I'm sure we'll get into in another video, discussions of imminent rate cuts are premature. And while bond yields did pop up during the press conference, they fell down shortly thereafter, indicating that it's not clear that the markets believe the governor.
I don't give a
Food inflation is over 4%, and the core CPI is still well over 3%. Does anyone really visit a grocery store and then think the Bank of Canada is going to cut rates in short order? When the usual suspects predict that rate cuts are imminent and house prices are going to take off thereafter, do they forget that homeowners' replacement costs are a key component of shelter price in the CPI index? If we do see core CPI come down in short order over the next few months, if the data shows that prices are indeed slowing, then I think we could see rate cuts. But the Bank of Canada governor is sticking to the data-dependent narrative. The bank wants to see the data. With that said, we will continue to track the Bank of Canada all next year on this channel. Make sure you click like and subscribe if you want to get those updates. But for now, thanks so much for watching.